Mary Holm, personal finance expert, joins me in Auckland studio. Hello.
Hello, Jesse.
How are you getting on?
I'm fine, thanks. And you? You're looking very summery.
Thanks. Yeah, maybe another week or two of shorts, then I'm going to have to give in and start wearing longs. I saw a good headline on RNZ the other day. Will mortgage rates get any better than 4.99%? And it starts to look a bit more attractive once there's a 4 at the beginning.
It does, even if it has got 99 after
Yes, that's right.
Yeah.
And they are falling, not perhaps as fast as we might like, but they're going in that direction.
And who knows whether they'll keep going down. I'm, as you must know by now, not in the business of forecasting these things, but certainly a year or two ago, I think people were pretty confident that they weren't going to stay as high as they were. But on the other hand, I don't think we're going to get them back to that sort of ridiculously low level they were
Was the pity.
a couple of years ago.
Well, it depends.
Yes.
It always depends on your perspective, doesn't it?
It does.
If you're retired and you've got a big heap of money, then the higher the better, right? Because it actually impacts your lifestyle.
On your term deposits and all of that. So, but I mean, I tend to have more sympathy for the people with mortgages because you've got this huge debt with the house prices these days, huge debts hanging over people. So, and there was such an abrupt rising in interest rates in the last few years that, it must have left people reeling, I reckon.
I'm surprised we didn't hear more stories of people being forced to sell homes. In fact, that number seemed quite low. And
yes, it did.
Bernard Hickey keeps an eye on it, and he reported that actually the number of sort of, what are they called, mortgagee sales was still pretty low. But people must have been feeling the squeeze, whether in public or in private.
Yeah, I think that for one thing, people will do anything not to lose their home and make big sacrifices in other areas. But also the lenders really don't want to do that. It doesn't make them, no one loves a bank that forces a mortgagee sale. And so they sort of tend to bend over backwards, I think, and give people mortgage holidays and things, which we've talked about, when the rates were so high, or extending terms, or there's various things people can do. And so in a way, it's not that surprising. It's really good that there haven't been many mortgagee sales. Yeah. But anyway, we're on the more positive side now.
On the downward slide, hopefully.
Yes, with rates falling.
And so the topic today is getting wise with mortgages.
Yeah, and there's a couple of different points I wanted to make. The first one is when your interest rate falls, if you can keep up the old payments, it makes a huge difference. I realised as I was writing that people, it's a bit late in some ways because rates have already fallen quite a lot for people.
But not everyone's locked in the new rate, right?
No, not yet. That's right. Yes,
that can take a couple of years.
It can, If you've got a 2 or 3 year loan, it can take quite a while. But even if your rates have gone down, your term was up, if you've got a fixed term mortgage or if you've got a variable rate mortgage, your rates have already gone down. There's nothing to stop you going back to the lender and saying, hey, I actually want to increase my monthly or fortnightly payments so that I can get rid of this mortgage a lot faster. So if people out there are saying, look, I used to be paying $800 a month and it's gone down to $650, and I didn't manage at $800, I managed. They can, at the end of their term, if it's a fixed term loan, go to a lender and say, I want to increase my payments, and the lender should accept that. For any people, by the way, if you're having any problems making changes that I'm going to suggest, talk to a mortgage advisor and, maybe change your lender. Well, they're called mortgage brokers, mortgage advisors, they're called both. But there are ways around these things.
If you have a mortgage that lasts 25 or 30 years, the idea shouldn't really be that you struggle, and then suddenly you're in gravy and you get to spend up large, and then you struggle. Ideally, you would sort of even it out a bit, right? So you paid off So you paid approximately the same no matter what the rates were, and then actually
Yes.
when the rates go down, you're able to make a bit more progress on
add-
the mortgage. Yeah.
Add to your payments. So, yeah, I mean, look, I'm always conscious of not giving too many numbers. I'll just give one example here of the sort of thing that can happen to people looking at someone with a $500,000 mortgage and 25 years left to run. Or if they've got a 1-year term mortgage, the interest rate would have dropped from, they were up kind of 7.7-ish, which is shocking. And they've dropped down to about 5.7 now, that sort of range. So your payments would drop about $600 a month, which is a heck of a lot.
Yeah.
But if you kept up the old payments, you would save $145,000 in interest over the remaining 25 years of the loan, and pay off the loan 7 years earlier.
Gosh.
And that's huge. I mean, the $145,000 is not theoretical either. It's actually money that you could instead be saving for your retirement, or spending on travel or cars or whatever. I mean, but the thing is, it's not really theoretical money. It's money that you could have, because mortgages really often you borrow $500,000, you actually pay back a total of $1 million. You pay back about twice what you borrowed, in some circumstances even more. And so that huge amount of interest, which is kind of fair enough, because you've had the use of the money for all those years to buy that house. But nonetheless, it makes a big difference to people. And getting the loan paid off 7 years earlier, that's a big deal.
Yeah. So 7 years of your life that you don't have a mortgage for.
Yeah. And you can, at that point, have a bit more fun perhaps, but also get right into retirement savings. So that makes a big difference. Now, there are a lot of mortgage calculators out there, so people can go on them to have a look at how it would apply to them. But some of them aren't very good at taking account of the fact that you might be 10 years into the mortgage, or 5 years into the mortgage, or 20 years into the mortgage. So the one that I found that I think worked best is on the Money Hub website. Yeah, so that's just...
Love that
Money
website.
Hub, yes. Look, they've got some good stuff on there. And they've got a mortgage overpayment calculator, which says, I'm going to pay more off my mortgage. So they come through and you can calculate on that, putting in how many years you've got left on your loan. So I recommend using that one.
How are we going to find that?
If you on Money Hub, if you just search for mortgage overpayment calculator, it should
that works.
come up.
Yeah, found it.
Yeah, yes.
And this seems to be, although I think they make some money on referrals, but it just seems to be a smart guy with a background in money and finance, returning to New Zealand and deciding to put a lot of his energy into making sure New Zealanders get good deals.
I know Chris, and and I think his heart is in the right place. Yes, you should have a look at how he funds his website, but I still think he's got some good, unbiased information in there, and something like a mortgage overpayment calculator. I mean, you can use anyone's mortgage calculator, any banks or whatever. You're just putting your numbers in and getting a result out of it. You're not committing to anything at all. So that's worth doing. I also wanted to talk to you about 3 less common types of mortgages. There's offset ones, redrawable. Redrawable is a hard word to say. Redrawable, and revolving credit mortgages, and they're all available only with variable rate. And a variable rate mortgage tends to have higher interest, although if you look back in history, that it isn't always so. But currently, in recent years, the interest rates have been a bit higher, but nonetheless, these particular types of loans could really help lots of people to get rid of their loan faster or pay less interest on it. So looking through at them, and by the way, not all lenders offer all of them, but there's quite a lot of the big lenders do. One is called offset. And basically what happens if you've got an offset mortgage is that when the bank comes to calculate your interest at each payment time, they credit back all the money you've got in bank accounts with that bank. So if you might have a cheque account and you might have some other savings accounts with the bank, and they might have a balance that totals a couple of $1,000. So that's subtracted off your mortgage before they calculate the interest on it. And
do you still get paid interest on the other ones?
No, you don't.
Okay.
That's one of the catches. You don't get interest on your savings account or whatever when you set this up.
So the interest rate would be higher on your mortgage than it would for the savings.
That's the deal with all of these, really. What happens is you are effectively getting the mortgage interest rate on your savings account and on your cheque account and also some of the banks will let your family members also put their accounts into this pool, and you might want to just quietly, if your adult children are putting money in or your parents are putting their accounts into this pool, you might want to reward them a bit because they're not going to get any interest on the accounts. But buy them a bigger Christmas present or something like that. But
tax-free too, Mary.
That's right. Yes. Yes, I think that'd be legitimate. Yeah. On the redrawable ones, you have a separate bank account for the mortgage, but you can put in more money than you've got a regular payment you're supposed to put in every fortnight or every month. You can put in extra whenever you can afford to do that. It might be on a regular basis, it might be a one-off thing. And you can take that overpaid money out again whenever you need it. So any extra that you put in, all of these are actually really good spot for rainy day money. They're really good. If you've got a mortgage and you've got some rainy day money, which I hope most people do have, several $1,000s sitting there so that if you lose your job or the car breaks down or whatever, you've got something you can fall back on. This is a really good way to place to park that money.
Right, so you're getting something out of it.
Yes, you're getting the effective interest rate of the mortgage interest rate. It's because you're not paying, let's say, 5% on the money that how do we explain this? You've reduced the amount of the mortgage by $1,000, let's say, because you're using this other sort of sitting around money. And so you're effectively getting 5% on that money because you've got out of paying 5% interest on that $1,000. If you see what I mean, it's quite hard to explain, but the point is that it's a really good deal if you can't quite follow what I'm saying. And the third type is revolving credit mortgages, which I have talked to you about them before. When I had a mortgage, this is what I had, and it was basically you've got one account that with all your everyday money, all your income's coming into it, all your bills are going out of it, all your payments are going out of it, and your mortgage is in there as well. And when you first get it, you open up the account and the balance is minus, $800,000. And you go, oh. But you're basically getting credit for all the money, all your everyday kind of money against the mortgage balance. And so you get into this kind of game where you get all your income directly put into that account, and then you pay your bills at the last possible moment. So with power bills and those regular bills you have, set them up so they're paid on the last date. And in the meantime, there's money sitting around in that account that's reducing your mortgage while it's going on. It is kind of a game in a way, but
I think I find it a little bit hard to tell the difference between revolving credit mortgage and a redrawable mortgage.
Look, there isn't much. The redrawable one is just a separate bank account for the mortgage, so you then transfer money into it when you've got spare money. But with a revolving credit one, kind of automatically you're getting credit for the money that's sitting around.
Yeah.
So I think a revolving credit one would tend to be better. I should say that the banks, some of the lenders charge fees on some of these, and possibly the revolving credit mortgage might have a slightly higher fee. I don't know. Check that with your bank and other banks, and perhaps use a mortgage advisor or broker to help you with that. But
did you want to say anything about credit cards and revolving credit mortgages?
Well, with a credit, if you've got a credit card, that helps you to postpone making payments by 1 to 2 months, depending on when in the cycle you. So if you go to a restaurant and have a meal tonight, you're not actually going to pay for that meal until 4 weeks or more away, 4 to 8 weeks, I think, something like that. And so that works really well with the revolving credit mortgage, because in the meantime, that money is...
You keep your restaurant meal money in your mortgage so that you're not paying interest on it.
In the meantime, yes, until the credit card bill comes in.
This all sounds a bit wacky, but it's quite common. And if you went to your bank and said, I want a revolving credit mortgage, they would understand exactly what you meant, and they would probably be able to explain how it works and set it up for you. Right?
Yeah, they should. And I think all banks offer those. If they don't, you can go to another bank and do it with them. Bank loyalties is not a thing anymore. One warning about revolving credit mortgages is that you can borrow. You can just take money out of it whenever you want to, and that raises the mortgage balance. So if you wanted to go on holiday, you can take $10,000 out of the bank account.
For better or for worse.
Yes. And so you've really got to be a bit disciplined about getting that balance of that account going down over the months. You don't want to be just letting it. And in fact, quite a lot of them these days have a sinking lid on the maximum amount of the mortgage, so that you aren't allowed to borrow as much after a year and after 2 years, and so on. So look, if you're not a bit disciplined about your money, I wouldn't get one of these, because I think it can be a bit dangerous.
You can pretty much buy anything anytime.
Yes.
After a while, once you've paid a bit of it off.
That's right. That's right.
A couple of questions. Do you want to finish what you were going to say first?
Well, there's just one more quick thing. Reducing the term of your mortgage, if you want to have a look at that too. If you've got a 30-year mortgage, you might easily be able to afford now to turn it into a 25-year or a 20-year loan, or possibly even shorter. And that really that's where you're getting these huge savings of, $100,000 in interest or $200,000 in interest or something over the life of the loan.
Is that just sort of another way of saying that you'll pay more per week?
Yeah. It's just kind of another framework for it,
right.
if you will. But so if you are on a fixed term, you almost certainly have to wait till the end of that fixed term, although you can often go to them and say, I want to pay an extra 100 per fortnight or per month, and they'll let you. So always ask. But if you can just get the mortgage payments down, because so many people get a loan and at the beginning they're struggling to pay it back, but 10 years later they're not ready. They've had pay rises in the meantime, and they could manage to pay it off faster, and it's such a good thing to do if you can.
Questions. Comment from David in Tauranga. 7.7% shocking. You young whippersnappers need to harden up. I remember paying mortgage interest of more than 15%.
So do I.
I know you did.
I'm not very whippersnappery.
With the offset mortgage, can we use our KiwiSaver balance to offset it?
No, unfortunately not.
Even if it's with the same bank?
That's right.
Yeah.
No, good question, good idea, but no, you can't.
You may have to think about this one, Mary, or come back to us, but this person wants to know, is it better, i.e. quicker, to pay your mortgage weekly or fortnightly rather than monthly? Any thoughts?
I suppose, fortnightly versus monthly, people often say you pay it off faster if you do it fortnightly, and that's because there are 26 fortnights in a year versus 12 months in a year. And so if you pay half as much fortnightly as you do monthly, in the end you are paying it off faster, if you see what I mean. Weekly versus fortnightly, I don't know. It depends I'm not sure because I think they look at the balance daily. I'm not sure how that works. It might be a tiny bit better. Yeah.
Thank you. And thanks for your messages on 2101. Winnie in Auckland asks if we can think about renters sometime as well as mortgage holders
Good
and
point.
people who've paid off their mortgages. That might be one for the future, eh?
Yes, I'll make a note of that. It's a really good point.
Thank you.
Yeah.
Lovely to have you in.
Pleasure, Jess.
Mary Holm.